Why don't we start off with this? What do you think's at stake with the jobs report coming up later today? I was mentioning earlier, I talked to a lot of people. They think not necessarily a market mover. They think the cut's already baked in unless we see an outside move, either 10 to 15,000 to the upside or 10 to 15,000 to the downside.
Yeah, there does have a feeling a little bit of deja vu. You think about a year ago, there was a couple of troubling payroll reports followed by that full year revision that caused a lot of movement in the Fed. That was the 50 basis point decision. That has some similar feelings here. We have, Juliana just mentioned the calm before the storm. That's what this week certainly feels like. So I think it actually will have a meaningful impact because, yes, this cut in September is fully baked in. But as we go forward, there's still a lot of movement in expectations over the next 6 months.
So if this is the calm before the storm, what's the storm? Like what leads to the storm? Is the storm caused by the Fed decision, whether they cut, don't cut? Is the storm caused by maybe CPI and it changes investors' opinions of the possibility of that rate cut coming up? What do you see as the potential storm here?
Well, from a fundamental perspective, the primary driver going forward is going to be those earnings revisions that have turned higher. And obviously, the consumer is the largest piece in that continuation. So the consumer really will continue to spend if two things happen. One, they feel comfortable in their job, and two, the wealth effect stays high. So there is a lot at stake for both the labor market, but also the health of the equity market and the housing market, which we know has been a little bit choppy lately. So the direction of earnings is the primary, either both opportunity and risk for the market. And that's going to be largely driven by the consumer, which is why there's so much emphasis on the current state of the payroll report.
You know, it's funny you mentioned the housing market. Talking to a lot of investors, they say right now seems like a good time to kind of put money into consumer cyclicals, also companies tied to the housing trade, names like a Home Depot or even a Caterpillar, with the idea that not only houses will be built, but also commercial buildings will be built if we start seeing a rate cutting campaign. What sectors are you looking at as having the biggest upside going forward from today all the way into that cut? I know it's kind of a small window, but what do you see doing better? Because we've seen the broadening trade slow down a bit ever since Jackson Hole.
Yeah, the breadth and the momentum have both slowed, but it's still in a relatively positive camp. And again, this buy the dip mentality still feels very embedded in the market. So I think the bias definitely is higher as you move forward. But when you talk about specific areas of opportunity, it's going to be the areas where the risk reward profile is actually beneficial, but also fairly early cycle. So things like financials, industrials, some of those consumer discretionary stocks that have that aren't necessarily the high flyers. We've seen the strength in small caps as well. So some of the areas that are seen as more early cycle are the most particularly the ones that aren't at elevated valuations are going to be the best opportunities in the near term.
Mark, we got to get going, but I can't let you go without asking about bonds. We've talked a lot about bonds here on the show this week. What's your view on bonds? We continue to see yields move to the downside, but sometimes it feels like it's not so much the idea of a rate cut, because we see the long end holding up. It's on possible concerns about the economy, and that's why we see the long end holding up. What's your view on the investability of bonds right now? A report came out just a few days ago that bonds actually had a negative return in September. Are bonds a good place to put money at this current situation?
One of the most difficult things in our business, and the thing we collectively do about as bad as anything else, is predicting interest rates. So I don't necessarily have a perfect crystal ball here, but I've actually been interested in the fact that rates have been coming down in an environment where most people were talking about inflationary impacts and we were going to have a spike higher in rates. So the fact that the long end has actually been fairly stable and actually come down, I think is a good omen for the fact that the economy is in a bit of a Goldilocks scenario, as you alluded to earlier. So the bias of rates seems to be heading down, and unless you have one of these significant shocks with regards to inflation going forward, I think the bias is down.